Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is The Art of Your Deal, a roadmap to making your merger or acquisition happen. Before we begin, we need to cover just a few important items. Please take a moment to close any other programs that you have running on your computer and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors, per NASBA. In order for you to receive your 1 CPE credit for today, you must complete 2 requirements. The first is that you participate in all 3 of today's polling questions. And please note that GoToWebinar does monitor your participation in those polls. Next, you'll also need to complete the online evaluation. This will appear on your screen immediately after the webinar ends today, so please don't close your browser before you've had a chance to complete that survey. Once you've met both requirements, you'll receive your CPE certificate via email. That'll be sent to you within 10 business days. Now, in order to fully participate in today's webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top that you can use to minimize the control panel if you wish. And all the participants will be muted, but if you have any questions, you're welcome to communicate with us by using that question box toward the bottom of the control panel. Just type your question and click send. If we have time, we'll answer those all either throughout the session or at the end. Now finally, I'd like to remind you that Transition Advisors 1-hour CPE sessions each month. You can see there a list of our upcoming dates and topics. We have sessions including one on partnership agreements later this month. Next month is new practice niches and preparing your firm for an up. You can view, including links to register for them, on the CPE courses section of Transition. Now, before I turn it over to Joel, we'll go ahead and launch the first of the 3 polling questions for today. So you'll see there on the screen, this question is, how many equity partners do you have in your firm? And your options are 1, 2 to 4, 5 to 10, or 20 plus. So we'll give everyone just a couple more seconds to answer the question. Okay, I'll go ahead and close the poll. We've got nearly everyone. Joel, 72% of the folks on the call today are sole proprietors, and then 12% each of that 2 to 4 and 5 to 10 range, and then the remaining 4% are in 20 plus.
Thank you very much, Nikki. And that's a pretty standard number for us. I mean, there are 45,000 firms that are members of the AICPA. People forget how top light it is, because you have your top 100, then you have the G400, which brings you down to about 8-9 million. Then you have the other 44,500 CPA firms, and most of them are 1 and 2 partner firms. But welcome, everybody. It's nice to see that not everybody's on vacation this week. I'm jealous of those that are. I am Joel Sinkin, the president of Transition Advisors, and we never treat for commercial, but I do think it's important to have a little bit of a background on the speaker. For the last 26 years, the only thing I've done is help accounting firms in growth and succession plans through mergers and acquisitions. And we've consulted on over 800 closings of accounting firms. So fortunately, you're listening to us in 2016, not 19, because we've made a lot of mistakes. We've seen a lot of mistakes, but we try not to make the same one twice. So we've kind of gotten ourselves in a little bit of a position of strength at this point in time. I'll start almost every CPE session with the same thing, and that's, if there's 50 things you need to know when you're doing a transaction, the smartest person in the room is usually only going to think of 35. And we're not going to get you into the 50 category today. We're hopefully going to get you into the 40s. But what you have to understand is I could take 5 practices doing the same amount of revenue with the same amount of partners and the same amount of staff, and then maybe nothing else the same about them. The unique nature of each of our firms dictates different types of strategies, and that's why there's never parameters that cover everything. But we're going to work with common sense and the things that handle most. Today, our mission today in our 1-hour class is to create a roadmap for you to follow so that if you're looking to do a merger or an acquisition, whether you're the successor firm or the mergee or the seller or the buyer, as a flow to what to do, then we'll talk a little bit about some of the roadblocks that come up frequently and perhaps how to navigate them. At the end, we'll speak a little to the key to all things, and that's retaining the clients. I'm having a little computer problem. It changes pages on its own now and then, so please forgive me. The IT people are working on it, but they didn't get it done today. Let's start with the fact that whenever you're entering into the merger world, the first thing you got to know is, why are you doing it? See, firms are usually looking for a merger for one of two reasons. One, they're looking to grow, and the fastest way to grow is through a merger or an acquisition as opposed to client at a time. The other reason people are looking to a merger is usually to solve a problem or a headache. Not all problems are bad problems. Maybe, for example, I've got some great young talent and I want to promote to being a partner, but I don't want to suffer the book of business being broken up into pieces, so I look to acquire another firm as a tool to promote people. Excess capacity with some new hires. Reasons people merge, but you got to start by knowing what your goal is of the merger and what's the other firm's goal. And by understanding that, it gets you a jump start into the process. Let's take an example. Let's say that Nikki and I are a two-partner firm, and Nikki, which is true, is much younger than I am, and I'm looking to slow down in 5 years. Well, one of our things that we're going to look for is a firm that has the capacity on a partner level to replace me. So once we knew our goals, it helps us understand what type of firm makes the most sense to match up with. So this is how we start the process. But now we're going to go into this merger world. What do we do? These are 7 general steps to follow. The first step is to author a generic practice description that basically shares what we have and what we're trying to get done. And I'm going to go through each one in more detail. The next thing is I'm going to organize my must-haves. The third thing is I'm going to decide what my merger partner should look like. Then hopefully I'm going to have initial meetings with them. Hopefully I'm meeting more than one, so I have a yardstick to make this decision, and I narrow the field down to the 1 or 2 that I feel comfortable with. We get an offer. If we accept the offer, we do due diligence. We close the deal. Isn't that simple? 1 through 7 like that. Let's look at each one a little different. I think what a lot of people don't do at the beginning of the process is to share enough information. Now, let me say, I'm not talking about having people come in and perform any level of due diligence on either party's books and records. I'm not talking about sharing names of clients or anything of that nature at all at the onset of the process. What I do like is to put together what ultimately is going to be a 2 or 3 page profile. Part of it's going to be detailed information about my practice, as generic from a name perspective, but detailed. For example, how much is my gross revenue? What are the services I'm rendering? What's my staff's billing rates? What's my billing rate? What percentage of the gross are we making to the bottom line? How much space do I have? When does my lease end? How many partners do I have that are looking to stay on, that are looking to slow down? What kind of technology do I work with? What are the goals of my deal? Is it growth for some partners, succession for other partners? We're looking for more talent on the bench. We're looking for a bigger platform of services. Many multi-partner firms have partners in different places. So maybe I'll have 2 or 3 partners looking to grow professionally and financially. Maybe another 2 or 3 that are looking to slow down over the next 2 to 7 years and need a succession solution. So what does success look like? So I want to have this detailed information about the metrics of the practice. How many 1040s do I do? What does it generate? What percentage of those 1040s are for my business clients? This information is pretty readily available. Let's put it together. Let's also put together what the goal of the merger is. Is it a sale? Is it a merger? And if it's a merger, what's the goal of the merger? Again, is it adding talent? Is it growth? Is it a marketplace merger? I'm in Chicago, but I really want to also have an office in California. I'm in Texas and I really want in Houston, but I really want an office in Dallas too. Is it a two-stage deal, which is a deal that we've taught and written a lot about? And if you're not sure what it is, you can go to our website and look at the article on the two-stage deal. It's a method of structuring a deal where if I'm 5 years or less from slowing down, I can retain my autonomy, control, and income, but lead to succession. If it's a sole practitioner, it's probably going to be one or the other. It's going to be a merger for growth of some sort or succession. For multi-partner firms, it's very rare that all the partners are in the same position. For example, this morning I was speaking to a firm down in the Washington, D.C. area. There are 4 partners. One partner would like this year to be his last year working full-time. The second partner would like to work 2 to 3 more years full-time before she slows down to a of-counsel role. The remaining 2 partners are 48 years old. They want to grow, but they don't have the capacity to replace the 2 senior partners. So in their sheet, they're going to say what they have, and they're going to express their goals. And part of the goal isn't just am I a buyer, a seller, a mergee, or merger, but what compensation am I making? Because most likely that's going to be a must-have. Very rarely is someone going to do a deal where they merge into a successor firm, put in the same time and effort, bring in the same revenues, and make less money. So what's the compensation that I'm seeking? And if I am looking at a sale, what type of compensation or valuation am I looking for in the equity of the practice? So this is still putting together this generic information. And one of the really important parts I should share day one is a must-have. Now let me tell you, a must-have is a very challenging thing no matter what it is, because it's a deal breaker. So the first thing you have to decide is, what's a must-have? What's something that I strongly prefer? What's something that I would like to have but not a big deal? If it's a must-have, put it up day one. I've had people hide the must-have. They want people to fall in love with them, and then they drop the bomb that I'm on the lease personally for the next 6 years, and I could never move into your office, so you have to assume my lease as well. If there's a must-have, it's a must-have. Put it up right away. Just try and limit your must-haves to things that are really that important. If location. If none of your clients come to your office, your location is only important for the people that commute to the office, which is critical, but it should give us some flexibility. I'm not going to do a deal if we're a 3-partner firm where all 3 of us aren't retained. So there are must-haves that make sense. Like I said before, it's a non-starter for me to put in the same time and effort, bring the same book of business in, and make less money. So some of those things are must-haves. They should be put out there day one. Equity can be a big roadblock, and we're going to save that to talk about when we talk about the roadblocks. Things I strongly prefer, well, maybe I'm a big IT person, and maybe we're on the cloud, and we're multiple screens, and we're paperless, and maybe that's something that's very important to me. Is it a must-have? Is it very important? Staff. I'll tell you, one of the most overrated things I run into are people who make a big deal about the name of the firm, especially my sole practitioners. My clients are in love with you. It is not the name of the firm. And if we do a transition correctly, it's not your name that matters, it's your presence that matters. That's the personal loyalty. See, very few of us really have a brand. Most of our clients aren't brand loyal, they're partner loyal. And if we send the message that the partners are there, it doesn't matter the name of the firm. But to some people, it could be a strong preference, it could be a must-have. These are the things you need to do. So now I'm going to organize this multi-page report. That the page 1 is going to basically say my goals. This is what the partners are looking to achieve. Then we're going to talk a little bit about the terms of the deal. Then we're going to talk a little bit about the metrics of the practice. So they may not know one name of my client, but they'll know what percentage of revenues I do that are audits versus comp versus tax. Now, the reason I want to prepare this right away, day one up front, is because if I hand this information to someone and they say, well, we never do audits, better to find it out now than we spent 10 meetings together to find it out later. The greatest commodity we have is our time. We don't sell product. We sell time. So, and expertise and all those things, so I don't want to belittle it. But the point is I want to invest our time wisely. So the next thing I'm going to think about is, what does my successor look like? Well, if any of you have been unfortunate enough to hear me teach for the many years I've been teaching for the AICPA and other places, almost every session I talk a little bit about my big 4 C's. Culture. Everybody always uses that catch-all phrase of culture. Cultures are defined in 100 ways. It's how we build clients. It's how we treat each other. It's dress codes. Even IT has a culture in it. So that's an obvious thing. What I don't think enough people spend time on is chemistry. A very simple rule of thumb I've always had is if you don't want to eat lunch with someone, don't merge or sell your practice to them. Again, especially your smaller firms where your clients are so comfortable with you, your staff's so comfortable with you, why would we think that they're going to be comfortable with someone that you're not comfortable with? The lunch test is a very important thing. The next C that people don't think enough about is continuity. For example, I'm speaking to you today from Long Island, New York. I know many of you thought I was from Texas. My accent is very deceiving. I'm actually from New York. And in Nassau County, there are 3,200 CPA firms. So clients have a huge choice of who to go to. They choose who to go to based on what? Comfort level. None of your clients, or very few of them, if any, know if you're competent or incompetent, because if they knew that much to measure your technical skills, they'd be doing the work without paying you, unless there was in a test situation. So you have your clients because of you. If someone's going to take your ship and turn it into a completely different direction and change the manner that clients are treated and served and charged, and why would you think the clients are going to stay? And the last thing people don't think about all the time is capacity. If I'm a 4-partner firm and 2 of us are looking to slow down, I need a firm that can replace 4,000 plus hours of partner level time. Do they have the capacity to do it? Those are the most important things in choosing the right candidate. It almost doesn't matter how deep someone's pockets or great their skills unless you get past the culture, chemistry, continuity, and capacity. But then there are important things of what my merger partner should look like. Are there any specialties in my practice? Are there technical skills that are unique? Size is an interesting thing. Size can be a proxy for culture, but it's not always. I consult on a firm in the West Coast doing $10 million that doesn't have one client that generates more than $15,000 a year in revenue. And I have a 2-partner firm in the Chicago area that thinks they're PwC. They have 10 clients. They're doing $2 million. And so size isn't always indicative of everything. And remember, bigger isn't always better. Better is better. Sometimes you have a small firm that does a voluminous amount of hand-holding on the partner level that wants a big firm because big is better. Is that big firm going to have a partner hold their hands and visit a client that pays $7,000 a year? Bigger isn't better. Better is better. Although many times bigger does become better. Location could be very important. Technology could be important. Even licenses. A great example of that is in the state of New Jersey. If you do municipal accounting work, you must pass and be an RMA, a registered municipalities accountant. So what does my successor look like? What kind of specialties, what kind of knowledge, what kind of capacity, what kind of location, what makes sense? So now we've gone through the very first 2 steps. And what have we done? We've identified what the type of candidate that we should be merging with looks like, and we've presented them with a voluminous amount of information that they can see, that they may not know generically, my practice, what I do, what I charge, how I work. If there's still interest, we should have our initial meeting. Now, the initial meeting, which should be the most important thing, chemistry checkup, this is where we are giving this information, and we're sharing a lot more information up front with each other. We're letting each other know about the must-haves. We're focusing in behind the scenes on the 4 C's, but we're discussing what success looks like. Now, hopefully, if I'm merging up, whether it's for growth or succession, hopefully I'm meeting more than one firm. sometimes there isn't that many that exist in your marketplace. But if there is, I always encourage you to meet more than one firm. When we're working with people, we always introduce them to a couple firms. The reason for that is this could be the last or most important decision someone makes that relates to their practice. Having a yardstick to make this determination could be very important. It creates a comfort lack thereof. Excuse me. So what I want you to do is have a couple of different meetings with different firms, and then create a pecking order. Usually people will narrow it down into 3 categories. First category we'll call forget about it. Doesn't mean they're horrible people, whatever. For whatever reason, they're not your successor firm. There's the top category, the firm that you felt the most comfortable with, that seemed to have the best culture fit, that seemed to enjoy the information and respond in a way that excited you as well. And sometimes there's that firm in between that you feel good about, but maybe they're a little bit more of a bridesmaid. So the forget about, let off the hook, the bridesmaid put on hold, and let's move forward by sharing this information. Even more detailed, perhaps. Not necessarily due diligence yet. Keep that in mind. That's a more invasive process. But maybe I'll share a P&L if there's still mutual interest in things that are more generic. Because my goal at that point in time is to get a non-binding offer. Now, this frequently sounds strange to people because in my scenario, we've met a couple of firms, we narrowed it down to 1 or 2, and usually we'll meet them twice. And I'm now, with no due diligence being done, a formal due diligence being done, I'm suggesting that we request the successor firm to give us a non-binding proposal of how philosophically and financially this deal would go down from their perspective pending due diligence. Let me tell you where this came from. In 1990, when I first started, I said to myself, these are great. I'm dealing with highest integrity, wonderful accountants. We're going to introduce them and let's see what happens. And people would have 4 or 5 or 6 meetings. Then they would go in and perform due diligence. They'd see everything was pretty much what the seller or mergee told them it was. Then they'd make an offer that was completely out of the ballpark of what anybody would accept. What an inglorious waste of time. Also, due diligence is a bit of an invasive process. Not only do you have to have non-disclosure agreements and confidentiality agreements, that's easy. But how are you going to explain this to staff if they're coming in during staff time? Are you comfortable sharing this information with every Jane, Tom, Dick, and Harry that comes in the door? So what we do is we say to the successor firm, look, we want you to assume that Tom and Mary are the Pope and everything they told you is the gospel truth, and make a non-binding proposal of how you see this coming together. We've given you a voluminous amount of information. We just want you to assume it's accurate. We've told you what we have. We told you what we're looking for. Respond. But make sure when you get that response that they're giving you a complete proposal. The worst thing people could do is negotiate in pieces. I cannot tell you how many times as a consultant we'll get phone calls, like I did just 2 days ago, from someone who said, Joel, we've kind of worked everything out, but I need a consultant to help us in what we should look for in due diligence and drafting the agreements and helping us plan the transition, announcement letters, integration, things like that. I said, great, send me the term sheet. I get the term sheet. I see the multiple was agreed upon. I even see the payout was agreed upon. But then I call the 2 parties that hired me up. They hired me jointly. I said, you know what? There's nothing here about tax ramifications. The buyer says consulting. At the same time, the seller says capital gain. I say there's nothing here that talks about the treatment of AR and WIP. There's nothing here that talks about the retention period. Is this a fixed guarantee? Is it impacted based on the future retention of the clients? So the problem became, because they didn't agree on these things, it changed everything else. For example, is the multiple the same if there's not a retention period versus there is? Is the multiple the same if it's a goodwill transaction versus a transaction that gives the successor firm a current deduction? Of course not. So what happens is you start negotiating much more, and then you have to go backwards. So when I ask for a non-binding proposal, I'm asking for a detailed what is the valuation, what's the payout, what's the retention period, what's the tax consequences, how are we handling AR and WIP, if it's a merger, what about the capital requirements, how's the compensation look. I want to make sure that we're in the same page here. Now, if we've gotten an offer that we thought was acceptable from a firm that we felt comfortable with, we go to our next stage. That is, now is the time to perform due diligence. Yes, we shared a lot of information, but now's the time to share that information by letting each other look in. Now, let me say one thing, because as we'll talk about shortly, time kills all deals. Think of due diligence in 3 phases. Some things I ask you for are readily available. Some things you have to dig up and put together. Some things I might want to come to your office. People wait for all 3 categories to be done before they start the due diligence process. Deals have a momentum to them. It's important to keep it going. So what I try and recommend is, if you ask me for certain information, and I assume that we already have a non-disclosure confidentiality agreement, I'm going to, if what you're asking me for I have readily available, why not email it? Why not share it with you right away? And set up time frames where I'll have the rest and things of that nature. Now, if, again, on our website, there's a lot of articles. There's articles on due diligence. Here's just a couple things to look at from the mergee or seller's perspective. Couple things. The first thing is, if that firm I'm talking to has ever done a deal before, I want to speak to the people they did the deal with. I'm not expecting to hear horrible things. I'm going to expect to learn some valuable lessons that they learned. I want to know more about them. You know, I will tell you that I've been involved in over 800 closings of accounting firms, and no successor firm ever did a deal that they didn't do due diligence. And how rare it is the firm merging up did any. At least run a background check. If they're robbing from Peter to pay Paul, do you want to wake up one day being Peter? Do you want to know what their retention rates are? Because if they can't keep their clients, what makes you think they're going to keep yours? If I'm merging into that firm and going to become a partner, the most important document I need to see is the ownership agreement. Doesn't that tell me how governance and compensation and buyouts and buy-ins, all these things work? If it doesn't, it's a horrible ownership agreement. Give us a call. But these are important things to look at. So it's not just debits and credits. There's some other things. Same thing I want to share from the successor firm's perspective. I'll tell you some of the things. The single most important thing that I'll probably look at is how long the mergee or seller has had their clients. Because the longer they've had their clients, the more loyal those clients are. And the more loyal those clients are, the more likely I can retain them. Kind of counterintuitive. I've had a lot of people say, no, you know, my clients are so loyal to me, nobody would keep them if I wasn't there. Well, if that's the truth, then your practice is worthless. Why would I take on your practice if you're telling me I couldn't keep them? It's actually the opposite. If we do a proper transition and they're that loyal to you, and many of my small firms, they're on 2nd, even 3rd generation of their clients. They've seen them baptized, bar mitzvahed, and married, and now they have a business and they're their accountant. These are cherished relationships that can be easily transitioned by taking, in a moral way and an ethical way, advantage of that loyalty, as we'll talk about shortly. But there are 2 big mistakes that successor firms tend to make in due diligence that I want to take a moment to help you avoid. And then, Nikki, I'll make sure we get to our next polling question. I think the first thing is, I call it the great mystery of profit and the great mystery of billing rates. These are the 2 things I want to talk about. Let's start with billing rates. You know, a great example of a story I've told is I had a deal just a year or 2 ago down in Florida. It was an unusual firm. 2 partners. They were only doing about $1 million. They had no other CPA professionals working for them. Everybody else was a para. The 2 of them did 100% of the heavy lifting, but it was a lot of back office work, and the staff handled the rest. So a small regional firm down there was in the middle of doing this deal where we were consulting on it, and the firm calls me up in the middle of due diligence and says, Joel, there's a problem. Even though they gave us this sheet at the beginning, we should have realized it. We just came to the hard truth that this firm we're talking about buying, the partners are only making $200 an hour because our partners make $300 to $350 an hour. We can't do this. So I asked them, since they were in the middle of due diligence, not who's going to hold the client's hands, but who's going to do the work. I said, so you had two partners there. They were doing all the heavy lifting because they didn't have any leverage of managers, seniors, and juniors. So I said to this successor firm, what level staff would do that work that they're doing? And he said, well, Joel, most of the work they're doing is senior level work. So other than the hand holding, almost all of that was just senior billing rate. They said 150. I said, I guess they're getting 200 an hour now. See, he was so busy focused on a piece of paper that dictated their hourly rates, he never transposed what that billing rate would be in the successor firm. Maybe my technology is so much superior and I am so much more efficient, it will take me less time and effort to derive the fees, in which case my billing rate's going to go up without raising the fee. And I've had the opposite happen. 6-7 years ago in Philly, there was a very classic example. I haven't seen it a lot, where there was a firm we were doing a deal with. 25% of the revenues came from audits. Their audit partner handled the audits by himself from beginning to end. The successor firm said, well, wait a second, I need 2 pair of eyes for our quality control process to review all that work. They realized it would take them 40% more time and effort to get that done under their quality control process than the firm they were merging in which case the billing rate would have dropped. So if my QC process is more robust and I can't make other things more efficient, it's a problem. So we can't look at a problem. I got the same issues with profitability. Everybody wants to value every business based on profitability of the seller. Who cares what their profitability is? I want to know what my profitability as a successor firm is going to be. Let me give you an example. Let's say that 5 years ago I had a $300,000 practice. I operated out of my home. My wife, Kathy, answered the phone. My net was what, 85%? Then we decided that we were tired of people knocking on the door. I took an office. She didn't come with me. I hired an office manager, and now I'm netting 40%. At which more to you? It's irrelevant. If you could absorb my practice with no incremental increases in overhead, it's very profitable. Conversely, if I tell you that you got to keep my office and you got to keep my office manager and she makes $125,000 a year, but in 16 weeks paid vacation, but you got to keep her. I want goodwill, even though you're paying me over 5 years and have to deduct it over 15. Profitability is the profitability of the successor firm. It's not the profitability of the seller. So you have to transpose billing rates. You have to transpose profitability. You got to look at the culture, partner billable hours, size of book managed. These things could be very important, for example, in a merger. Maybe in my firm, every partner has $1 million book of business. In your firm, they have $400,000. Will they be able to be a partner for us? Compensation could be a proxy for culture, and let's not think that our seniors won't all be talking to each other about what they all make. So there's due diligence is more from the successor perspective of not so much just looking historically at what the practice information is going to tell us, but when we have to learn to translate what it would mean, what that firm would look like in the successor firm, and see if that's an improvement in the numbers or a challenge in the numbers. But let's make sure all of you get your CPE for listening to this New York nasally sound of mine. Nikki, can we give them the second polling question, please?
Sure. The second polling question's on the screen now. In the next 5 years, your firm is likely to sell, acquire a smaller firm, merge into a larger firm, or you're not sure. We'll just keep this open for about 10 more seconds. As Joel mentioned, this is the second of 3 polling questions, and you do need to answer all 3 in order to get your CPE credit today. Okay, that's nearly everyone. I'll go ahead and close it. The results are there on the screen. 31% said acquire a smaller firm, 28% not sure, and then 25% merge into a larger firm, with the remaining 16% saying that they'll sell.
Wonderful. Obviously, the majority of people attending this session have some level of interest in buying, selling, merging. And it's very typical today. I mean, it used to be something that people spoke about, but not so openly. Now everybody's talking to everybody, and it's a very unique marketplace. I work very closely with the AICPA, and the statistics of the quantity of deals that are happening are just overwhelming. But remember, doing a deal has to make sense for both parties. If one person wins and one person loses, we all know that doesn't make sense. So let's make sure that we're going about this in a complete way. Now, once we've done our due diligence and both merger buyer and seller are happy, we had a proposal that we accepted, if you recall, prior to that, now is the time to close the deal. This is also the time that we tend to bring in the attorneys. Now, some people want, for some reason, to have the attorney involved before this. I've never been a big fan of that. See, the way I look at it is, as a CPA firm, you have the expertise in the cash flow and the numbers. That's not the attorney's job. Your job is to figure out that the deal makes sense from a cash flow, from a culture, from all the different basis points that you need to look at to say this deal makes sense. The goal of the attorney is to take the deal that you've agreed to and memorialize it. I've often been asked the difference between the proverbial attorney that makes the deal versus the attorney that breaks the deal. My response has been that the attorney that wants to tell the CPA firm, we need to renegotiate this deal, well, you got to let me negotiate the deal. That's usually the attorney that's going to get a really big pay from a big fee on a deal that's likely not going to happen. The attorney that says, you're the experts in the numbers, you did the due diligence, not me, you've met with these people, not me, you're comfortable. My job's to protect you in the document to make sure not only does it memorialize what you've agreed to, but all the exposure and liability circles are closed, all those types of things. That's the attorney's job. Keep in mind, as someone who's been doing this for 26 years, nothing aggravates a party more than when a contract comes with something new in it that's never been discussed before. A contract is not a tool for negotiations. A contract is to memorialize what we've agreed to. So what I always encourage people to do is, hey, if the attorney comes up with something that's important, I'm not saying ignore it. What I'm saying is don't just send it to them in the other party in the contract. Call them up. Hey, Alice just told me that I forgot about this issue. We needed to address it. Here's what we're recommending. That's great. Full disclosure. But the first time someone sees something in a contract they never heard or spoke about before, they start wondering, is this a character flaw? Is there something else in there I haven't seen? Maybe I have to read this 15 more times. And trust me, the 15th time you read a contract, it always means something different than the first 5 times you read it. Suddenly there's things missing and things that suddenly are interpreted differently. So once you have an oral agreement, close the deal and bring in the attorneys. Now, I will tell you that it's been very rare that we close the deal and have the effective date the same. So many times, for example, just the other day, in accounting today, we had a couple of deals, one with Clifton Lawson and one with a forensic accounting that we consulted on. They closed the deal. It's not effective right the same day. It's effective a couple of weeks or months later. Kate Space, I've got to plan technology. I've got a lot to do. It's hard for me as the successor firm to start investing time and energy and money into this integration plan before I close the deal. So many, many times you'll have a signing where it's closed, but we have to wait for the calendar to flip to a certain date for it to be effective. Now, this is different than a house. I'm not talking about going to contract and then closing. I'm talking about contract closing simultaneously, just having a different effective date. But a lot of people choose to wait till they get all their ducks in a row and have the integration ready before they close a deal. It's a little riskful, because what happens if suddenly somebody changes their mind and I've already invested into new space, signed a new lease, done things of that nature. So be a little bit careful about that. Sorry, my technology is once again having a little bit of struggles. One of the things that when you've done as many deals as we've done, that you get accustomed to seeing are certain roadblocks. And one of the biggest roadblocks is the one that we've all heard 100 times: time kills all deals. The problem, though, is I don't think enough people have ever discussed why and how time kills all deals. So I want to spend a few minutes on this because I think it's that important of a subject. The first thing is, let me say to you, is that you can't be in a more adversarial position than the difference between, for example, a buyer and a seller. As a seller, I want to get paid the most I can possibly get paid. As a buyer, you want to pay me the least you can possibly pay me. It's the nature of the beast. It doesn't mean we're going to beat each other up, but we have to respect the fact we're going into this from wholly different positions. And the longer you negotiate, the more likely something becomes adversarial. I've been many times in the position where people say, I don't care if they want diamonds for nickels, one more change, I'm out of here. Or how many times we've wanted to say, hey, if I don't hear by July 1st, I'm out. That's my ultimatum. So in other words, it's a great deal if I hear July 1st. It's a horrible deal if I hear July 2nd. That's what people are going to think when you say that. So we got to avoid it becoming adversarial by keeping it going. It's not a sprint. It is a marathon. But there's not marathon runners that stop and take a 10-minute break and then start running again. They keep going. So it's very important to keep your momentum going. Another reason, and which, by the way, we're talking about these 7 steps. If you notice, the whole point of it is to keep the process going, having a flow to it. One of the other great lessons I've learned about time is the terrible messages it sends. A great story that I think is a great story is a deal that we did in the Boston area a few years ago. I had a firm that was a national firm, and they were merging in a firm doing about $6-7 million. And the $6-7 million firm said, hey, you know what, Joel, can you get me their employee handbook? I really want to just take a look at some of the perks and benefits and see where we may have some conflicts. It was a very lucid, appropriate question. So I called the managing partner of this national firm, and I asked him for it. And he said, Joel, you know, it's October 6th. And, you know, we have the October 15th deadline. And by the way, I assure you, this top 100 managing partner isn't doing anybody's tax return on that date. But anyway, he said, I got the October 15th deadline. Then I'm going out of town for a week. I promise I'll have it before Halloween. So I pay you over $100,000 a year. And he said, you know I do. Why? I said, so if they called you for something on your or your office manager's computer, that all you had to do was attach to an email and send it, you would tell them you'll get it to them in 3 weeks? And he got livid with me. He said, Joel, that's the most unfair thing you've ever said to me. It's ridiculous. How can you compare someone who's paying me money to this? I said to him, Mike, this firm's $6 million. They're potentially your biggest client. So here's the problem. You're sending them one of two messages. Either the message one is, I'm so darn busy, how am I going to handle another $6 million in revenue? Or, this isn't that important to me, it has to wait. And which of the two messages do you want them to take that as? Of course, he sent the email right away and realized I was protecting him, not beating him up. It's the messages that you send. If I'm a sole practitioner and I'm selling my practice, this is a decision, I'm so sorry for the screen, by the way. This is a decision way more emotional than it is physical, professional or financial. Many of us have an umbilical cord tied to our practices in our client base. Having to go through this process and then knowing it's the most important thing on my desk and not on yours is a challenge. Other reasons about time, the longer we negotiate, the more likely the word's going to get out to the marketplace. Maybe someone's going to step in and beat me to maybe the clients or staff are going to hear about it. So it's very important never to rush. We're not talking about rushing. What we are talking about is keeping the process moving. A couple other things that are really challenging in roadblocks. The first one is when you're more than one partner is unity of partners. You know, I can't tell you how many times I've had a multi-partner firm where the managing partner handled the whole thing and we worked out a whole deal, and then he goes to the board and the board says, well, we don't want to do that. Then why did we go down that road? Why did we invest all that time? You need to go into an M&A world with a united front. Now, if I'm 20 partners and 18 want to do it, you can't have unanimous anything. Unanimous, you know, you don't want the tail wagging the dog. But you have to have unity of partners. You have to be able to go in there and say to the group, this is what our goals are. What do you think? Does this work? Doesn't mean later there's not a vote and things of that nature, but you should go in there knowing that. You should go in, if I'm the successor firm, knowing what I have the capacity to do. There have been firms that have done mergers recently because the firm they merged in had capacity, and that was their goal of the merger. But we forget sometimes that if we don't want to bite off more than we can chew. Be careful about becoming impatient, especially the successor firm becoming impatient with the mergee. This goes back to my point about it being an emotional issue, a very stressful emotional issue. So I need you to stay patient through the whole process. You got to start looking at the transition. Once you have an oral agreement, you could assume due diligence is going to work out. You still got to do it, but you can assume it's work out. Let's start thinking about the transition issues. What about the staff? Do they have non-disclosure agreements? Do they have non-compete agreements? Is their compensation and perks and benefits package similar? How about the clients? Are we going to be able to make it look like we're going in the same direction? Another roadblock has actually become IT. There are some firms that just don't feel comfortable merging with people that are on a completely different level of IT. It's okay if we're both on the cloud and we use different platforms to get there. But IT has become a culture and has become a roadblock for certain firms. Additional roadblocks that you need to consider. One of the big ones I run into is equity. You know, sometimes people should be careful what they ask for, but let me give you an example of a headache with equity. Recently, in Manhattan, we had a 3-partner firm. They were doing $2 million. You had the 2 founding partners who used to be the 50-50 owners. But a year before, they decided, not because of merit, not because of business brought in, but because of retention and loyalty, they gave someone in their team a 10% equity interest. Now they're looking to merge into a larger firm for ultimate succession, but near-term growth. The problem, though, is they made someone a 10% equity partner. No firm that has met with them was willing to make that person a partner. They said not only did he just get it, but if you look at his ownership percentage, on 10% on $2 million, he owns $200,000. We have managers with books of businesses doing $750,000 who aren't an equity partner. How can I make them an equity partner? Equity could be a roadblock. Now, some firms have created these non-equity partner roles and places that could be a good landing spot. But if equity is a must-have, you got to deal with it up front, and it can become a roadblock later. And by the way, if I'm looking at a term for succession and I'm 5, 6, 7 years or less from getting out, why would I want equity? I'd rather take the non-equity partner position. I still have the title, still have the compensation, I don't have the liability and exposure for it. As we discussed earlier, another roadblock is the firm name. Some people get really stuck in the mud on it. And there's a lot of regulations. Each state could be different. But most states, if you're a CPA firm, then everybody who's a partner, whose name is in the firm, must have equity. Now I'm adding exposure because I felt I had to have my name in the firm. There's a lot of different aspects of this. There is a trick to the trade, though. The AICPA is comfortable, and most state societies are comfortable that if Gretchen bought my practice, she could say Joel Sinkin, CPA division of Gretchen and Company LLP. So get through the first tax season having the seller or mergee's name as division of the successor firm's name, that will work as long as the successor firm's still signing off on the all the work. So name could be a roadblock. Communication, keeping it open, keeping it friendly, keeping it frequent is an important roadblock to avoid. When the communication slows down, when people don't feel the love, quote unquote, a lot of problems. I would say one of the biggest roadblocks is unneeded must-haves, where people get really stuck in the mud about silly things. I don't want to, even if I could get out of my lease, you got to keep my location. Well, but the other location is 5 minutes away. You see, for example, a roadblock I've had people do unintentionally, but created their own roadblock, was when they knew they were going to be in the market soon to merge up. They knew they were going to be looking for a succession solution soon, and just re-up the lease. We had someone, it happens all the time, we had someone call from the Midwest a couple months ago. They were a $3.5 million firm and telling us how they wanted to merge up, some partners for succession, some partners for growth. And at the end of the conversation, they said, and by the way, we have beautiful, well-appointed space. We have great location, very favorable lease, market value or less in our mind, and we just signed an extension. So I said to them, what size practice do you think you need to be your successor? And they said, probably 10 million and up. I said, don't you think they have an office? What this person did by taking on an extension of their lease is they eliminated 80% of the people that would have been interested who didn't want a second location. And those who are interested are most likely going to reduce the offer they make to them by the cost of carrying the extra location. As a sole practitioner, for example, if I have a $500,000 practice and you have a $2 million firm and you don't have to keep my office and you could absorb me into your infrastructure with little to no incremental increases in overhead, then you could afford to pay me more money, which increased my value, and you'd still make more money. Everybody wins. So leases could be a very dangerous thing. And some cultures you just don't even try to mix. It's very hard to mix an eat what you kill firm where everybody's paid 100% based on the book of business they manage with a one-firm client philosophy. Or someone who charges retainers and fixed fees versus someone else who does pure time and billing. If we're not going to be able to compromise certain of these types of cultures, you're going to have a problem. So it doesn't mean it could never be done. It means someone's going to have to blink because you're not going to want to operate completely different within the same firm. There are things you could do to make your firm more attractive. For example, embrace technology. Go paperless, get on the cloud, or do a merger with someone who can help get you there. I recently had a firm come to me, and they were looking to acquire, and they said, Joel, if you had two firms, and they were the same value, same revenue, one was a little bit more profitable, had better blended billing rates and everything, but they weren't on the cloud, they weren't paperless, and the other firm, their metrics weren't as good, but they've embraced technology. I'll take the firm that embraced technology. I was shocked. I said, is that because it's going to cost you $15,000 a head to get someone to that platform of technology? He said, no. It's because it took me 10 years to get my partners and staff to throw out the paper to get to this place. I don't want to take a step backwards in culture. So technology can make you more attractive. Trying to get your clients more comfortable with more than just one person. It's hard to do as a sole practitioner. I know that. I respect that. But whenever possible, getting clients used to talking to maybe staff, other partners in those firms, it helps from a transition perspective in a certain way. Having clients that are well-trained and aren't so spoiled that they pay whenever they want to pay. And it's important to have a good understanding of what your firm's metrics really are. I've spoken to people, especially some of my small practitioners, and I said to them, what, on your gross, what percentage are you making? And he said, whatever's left after I pay my bills. I said, well, what's left? He goes, well, I'm not sure. He had impeccable records of every client, but the worst records of his own. I remember a managing partner of a firm I've always thought very highly of, a guy named Roger Siacco, who's like semi-retired now, once said to me, the most important client I have is my own firm. And that you want to be attractive in the marketplace, have realistic terms. Nobody does a deal to lose money. Just structured in a way that the successor firm's got some upside. But the greatest measure of success of any deal is client retention. Now, one of the first ways to get to the point where you're going to have better retention is to know that you're merging with someone that there's good chemistry, that they're going to be able to offer continuity, that the cultures make sense, and they have the capacity to assume, and the skill set, to assume the roles of those that are slowing down, if any. That everybody's going to win. The seller's going to be paid for their years of sweat equity, and the buyer's going to make more money. We've made an offer that was a complete package. We didn't negotiate one variable at a time. And the staffs that are merging, today, finding good, competent people is impossible. Keeping the staff that comes with a merger could be more for some people than the merger. But again, it's all about keeping the clients. If we keep the clients, everybody wins. So let's look briefly as we end this thing on some keys to client retention. The first thing is you got to understand what clients are afraid of, which we'll talk in a minute. So when I'm doing a transition plan, the first thing I do is I break down the clients, usually based on size, sometimes based on their ability to refer, and make a decision of how we're going to announce this to these people. Who's going to get a phone call, who's going to get a visit, who's going to get a letter, and when are they going to get the letter? For example, if I have some clients that I never speak to during the year, they're 1040 clients only, nothing else, and I close my deal July 1st, should I send them an announcement letter then? Or maybe wait till January when we send the tax organizer? Do I send an announcement letter to my biggest client? I'll tell you something, not only do you visit them, but you visit them with your new partners. 1991, I had a gentleman went out to his biggest client, said to him, listen, I just merged with John. He's a great guy. He's a super, blah, blah, blah. And the client said to him, Murray, that's great, but you're the only guy I deal with. If he brought John with him there, the client would have said, John, nice to meet you. Never want to see you again. You don't empower the clients. You're their most trusted advisor. You lead them to where you need them to go. And think about change in two perspectives. Change behind the door, change in front of the door. Let me explain. You were using Lacert, I use CCH. That's a change behind the door. Has no impact on client retention. Clients don't know. Change in front of the door is, I used to visit you quarterly as a partner. Now they want you to mail everything in, and a junior will come out once a year. That's a change in front of the door. I used to charge you 10 grand a year. Now you're going to pay 25. That's a change in front of the door. You gotta make sure that changes behind the door you could do right away. Changes in front of the door, if they're dramatic, you chose the wrong firm to affiliate with. If they're not dramatic, they're done incrementally. They're done slowly, and typically not right away. The key to a transition plan is knowing what clients fear. They have up to 4 fears. The first one is the person I trust still there? The second one is this going to cost me more money? Third one is, do I now have to drive someplace 2 hours away to meet my accounting firm? And for some of us, we deal with staff as much as partners. Are they going to be there? So, for example, if I'm sending an announcement letter out, and then when I visit those or call those, the message I'm going to deliver is going to be something like this. If I'm acquiring Nikki's practice, I'm going to take Nikki's clients and break it down into categories: doctors, construction, lawyers, wholesale, retail. So let's say the first person I'm calling is a doctor. Well, writing the letter to. Here's how I'd write the letter. If Nikki bought my practice, I'm the seller, I'd write in the letter, hey, I'm pleased to announce I just merged with Nikki. Nikki's an expert in the Obama tax laws and the modern computerization of accounting, especially as it relates to the medical community. Having her on board will enable us to provide you additional services, but we will be operating under the same fee structure. I will remain the principal in charge of you as a client. We remain geographically sensitively located in the same community, and the same staff you're used to dealing with are part of our new combined dedicated team of professionals. In the first paragraph, I said to them, I'm still there. I have an expert with me in your profession. I'm charging the same fee. I'm in the same area. My location's the same. The greater the loyalty between me and my clients, the higher my retention is going to be, because if I do that correctly. It's not the loss of me, it's the gain of Nikki. And there's little things you need to think about. For example, if I bought Nikki's practice, switching it around, when Nikki sends out the announcement letter, it should go in her envelopes with my stationery inside. If it went in my envelopes, people would think it's a solicitation and not open it. I should keep Nikki's phone line as a direct line in my office, so when I answer it, I don't answer at Joel Sinkin and Company. I answer at the accounting office, so you reach the offices of Nikki and Joel. Little things, but the emphasis is on the gain, not the loss. So when you're going in to do a merger, what you really want to do is you really want to make sure that you've identified the goals, put your information together, you've identified what a successor firm looks like, you go through the process, you keep these roadblocks in mind. For additional information, there's a on your screen right now, if you're a member of the PCPS division, we have a voluminous amount of succession and growth planning tools, readiness assessments. There's a 12-chapter book with all different things. It's free, it's available. Take advantage of it if you're a PCPS member of the AICPA. On our website, there's a voluminous of this, but got to be 60, 70 articles we've written, all sorts of stuff. It's all free. Jump on it. But stay with us. Nikki, let's get that last polling question.
Okay, our last polling question is on the screen. How many partners in your firm will likely slow down over the next 5 years? And as I give everyone a chance to answer this question, I'll just remind you that right after we close here, just momentarily, you'll see the survey pop up in your browser. So please take a moment to complete that before you close it. And if you've answered all 3 of the polls today and complete that survey, then you'll get an email from me with your CPE certificate within 10 business days. Also, at the beginning of the session today, I sent a link out to a PDF of the slides. You can also see that link in the GoToWebinar reminder emails that you received. But if you'd like for me to send it as so, you can just reply to any of the messages that you've received through GoToWebinar. And then finally, Joel mentioned that there are quite a few articles on our website, and in the email that you'll receive in about an hour or so, you'll see a link to some of the ones that Joel thought were particularly relevant to today's webinar. Joel, it looks like everybody's had a chance to answer the poll. I'll go ahead and close that now. And I think we'll go ahead and close the webinar. Thanks everyone so much for attending.
Have a great day, all. Thanks you, Nikki.